Hello, everyone. A very good morning and welcome to this particular masterclass. Can all of you see me? Can you hear me? Can I get some comments? Can anyone let me know if they're able to see me and if they're able to hear me? A very good morning. Suresh, Noor, hi. Are you guys there? So I would just need some comments from all of you telling me if you can hear me, if you can see me. Yes, anyone? Anyone? Yes, thank you, Ray. Hi, Ayush. Good morning. Great. So we're just going to start in maybe another 5 minutes because we're just waiting for some more people to join in. Hi, Sumit. Good morning. Hi, Soreen. Hello, Yasser. Hi, Suresh. Good morning, everyone. Hello, Atul. Good morning. Thank you so much. You're saying loud and clear. Thank you so much for that. Ayush, Ray, Suresh, Noor. Hello. How are all of you doing today? Hello, Sonali. Good morning. Hi, mobile gamer. Hi, Tahir. Hi, Sheikh. Good morning. Hello. Ajinkya Mane. Hello. How are you? Okay. Hi, Manoj. Hello. Hi, Beauty of Earth. Great. So I have a lot of you on the call already. Thank you so much. So just give me 2 minutes, guys, and we'll start the session because we're just waiting for some more people to join in. So I'm sure all of you know what's the topic going to be today, and I'm sure all of you are looking forward to it. So just give me a thumbs up, give me a yes, telling me if you're looking forward to the class today. Hi, Kisan Patel. Hello, Girisha. Hi, Suraj. Good morning. Hi, Tejas. Hello, Singh is King. Hi, Rajkumar. Jay. Good morning. Thank you, Adarsh. Thank you. Hi, Niranjan. Great. I'm absolutely looking forward to the class myself. And just waiting for a few more of you to join in and then we will start the session. Thank you so much, Sumit. Yes. So just give me another 1 or 2 minutes and then we'll start. So in case you guys want to tell me something, you want to know about anything specific about IPOs, do mention it on the comments and I'll be more than happy to, incorporate that. Okay. Hi, Anil. Good morning. Hello, Anand. Hi, Aniket. Hello, KP Pati, Suresh Dubey, Sumit Singh. Good morning, everyone. Hi, Jay. Yes. Anil ji, how are you doing? Anil Giri, how are you? Yes, so I have many of you on the call. Great. Yes, chances of getting IPOs. Yes, yes, sir. I am going to cover that today. Hi, Nilesh, Nitesh. Good morning. Hello. Yes, so today we are going to cover how to increase your chances of getting an allotment during an IPO. Okay. Great. So I think let's start. And, I know today's topic is very interesting. I'm sure a lot of you are looking forward to it. So I'm sure all of you want to know about IPOs. All of you want to understand what is this IPOs? Should I invest in it? And how should I go about doing it? Will I get the allotment? And, so many questions that we get related to an IPO. Today, we're going to try and answer most of them for you. Okay. So let's start. And if you guys have any questions related to anything to do with IPOs, you can just mention it, and I'll try to answer it towards the end of the session when we open for Q&A. Okay. I hope I'm loud and clear. I hope there are no technical glitches, and we'll start. So I have many of you on the call already. So let me quickly introduce myself. My name is Namrata, and I've been associated with Groww for a while. We've been doing a lot of content, online content for Groww. We do a lot of videos. I do a lot of masterclass. So yes, so I'm super excited to be doing this for all of you. And we've done many sessions in the past in terms of the masterclass where we try to explain a particular topic in detail, right? So this is exactly for an hour, and this particular session that we are doing is going to be in English. and I'm doing the same session in Hindi at 12:30 today. So if any of you want to listen to my session in Hindi, you can join in at 12:30 again. And this I'm going to talk in English, right? So please lay to language. I hope there are no, there's no confusion. Also, guys, please remember that we don't really, give recommendations. So if you're going to ask me, ma'am, is this IPO good, or should I invest in this company, I will not be able to answer those questions for you. Okay, so I hope that that clears it, right? So let's start. And before I really share my presentation, before I really, start the session, I just want to start with a very simple story, right? So in the 1600s, the British merchants, they started trading with Southeast Asian countries, right? So they used to trade things like spices, cotton, silk, pepper, salt, so many items that they used to trade with Southeast Asian countries. Now, in order to get the goods from one place to the other, obviously they were shipped, right? At that time, ships were the only mode of long haul transport, and obviously many ships were lost because of bad weather, right? And what happened, just imagine now, all the ships were owned by one individual, and if the ships were to drown, just imagine the kind of losses that one individual would have to bear, right? So then what they did was, the company took a very smart decision. They said, instead of giving the whole risk to one particular individual, we are going to divide that risk, right? So then what they did was, they said that, okay, now these ships are going to be owned by hundreds of people. So they started giving a small portion, or they started collecting money from everyone to give ownership of the ships to many people. Now this way, what would happen, even if the ships were to sink due to bad weather, the risk would be shared by all those individuals, right? And at the same time, when we're looking at the profits as well, it's the same logic, that even when the profits are made, those profits also would be divided amongst those individuals who are sharing that ownership, right? So basically, when we look at this particular analogy, what I'm trying to say is, I'm trying to say that the risk is shared. Right now, that's something that all of us have to remember, that when we are investing in equity, when we're investing in companies, when we're investing in businesses, the risk is shared, right, amongst all the shareholders of the company. And if you are investing in a particular company, which means you are a particular shareholder of that particular business, then the risk is shared with you as well. So you don't have too much, you don't own complete risk of the business. You own part of the risk of the business, depending on the number of shares or percentage of shares of that company that you own, right? Okay, so let me start this particular presentation with some numbers, right? I know a lot of times when we talk about numbers, or when we talk about a presentation, right, it is always said that you should never start a presentation with statistics, with numbers, but I want to take that risk, okay? And I'm going to show you some numbers, and then we'll talk about it, okay? So let's understand this. Yeah, so all of you can see this. So this is basically how the market has performed over the last few years versus the number of IPOs during that particular during a particular market time. So as you can see, 2007, right, when the markets were at boom, they were doing exceptionally well. We had 108 IPOs that came out in that 1 year. But in 2008, when recession happened, we had just about 39 IPOs. Now, I don't know how many of you can see this, right? But come to look at it, there is a direct correlation between how the markets are performing and the number of IPOs that have come out in a particular year. And there's a direct positive correlation, which means in years that the markets are doing exceptionally well, you would have, more number of IPOs coming out. And in the years that the markets have not done so well, the number of IPOs comes down. What's the reason for this? And the reason for this is really simple, right? When the markets are doing well, there's in general positive, vibes in the market. Everyone is positive about equities, right? And when there's so much positivity around, then you have more people who are willing to take that risk, who are willing to subscribe to IPOs. And then when that happens, and as a promoter of a company, don't you think the promoter would think that, okay, I would like to get subscribed fully, and I would want people to buy my shares? So obviously, when the euphoria is positive and the euphoria is high, that is when you have a lot more IPOs coming out in the market compared to the time when the markets are not doing so well. Because as a promoter of the company, you want to encash on the positivity that is already running in the market. Just imagine if the market scenario was negative, right? Then a lot of people are quite negative about equity in general. So they would not even subscribe to IPOs, right? Then the whole purpose of coming out with an IPO is lost. Yes. So which is why, as you can see, there's a direct correlation between market performance and the number of IPOs that come out. Okay. If we just look at, so now, so what you also have to understand is that sentiments play a big role in this whole process, right? So when it comes to market sentiments, they are defining how the companies are performing, they are defining how the IPOs are subscribed, and so on. But now the question is, with that logic, every IPO should do well, right? Every IPO that comes out in the market should do well if the market euphoria is high, logically, right? But then that is not really the case, right? I mean, come to look at it, not all IPOs are successful, isn't it? So if I just show you one more slide, and if I just show you the past performance of IPOs, right? A lot of us, I know of a lot of people who just want to subscribe to IPOs. They just believe that I will subscribe to IPOs and I'm sorted, right? Now let's understand this as well. Not every IPO that comes out in the market has given great returns, right? So if I just show you this particular slide that you can see, so okay. So if I just show you the total number of IPOs that have come out in the last few years, let me just go to that. Just give me a moment. Yes, yeah. So if the total number of IPOs we've had close to since 2010, we've had many IPOs that have come out in the market, actually close to 250 IPOs since 2010. Out of which, if you look at the number of IPOs that have given negative CAGR, or the number of IPOs that have never seen even their issue price, is 130 IPOs, which means they've given negative CAGR since they've been launched. And at the same time, it's only been about 47 IPOs that have given close to 25%, or that have given more than 20% CAGR, right? So what you have to understand is that just because it's an IPO, it's not like every IPO would give you positive CAGR, right? A lot of us believe that as an IPO comes out in the market, I'm going to subscribe to it and then I'll just exit with listing gains, right? But that may not be the case. There are so many IPOs that have never seen their issue price in their lifetime, right? So what you have to understand is that when you're looking at investing or subscribing to an IPO, don't just look at it as an IPO, look at it as a company that you want to invest in, and you have to do your own analysis of the company, right? And that is going to make all the difference, isn't it? So which is why it's not just about subscribing to an IPO, it is about understanding the business, understanding the fundamentals, understanding if it is really worth investing in that particular business, and then take a call whether or not you should invest in, because not necessary that all IPOs are going to give you positive gains, right? So basically, if, there are two types of investors that you should look at when we're looking at an IPO. So the first category is basically those short-term investors, right? They are looking at subscribing and they're looking at exiting after listing gains. So they say, okay, once IPO is listed, I'll make some gains and I'll exit. Those are your short-term investors. They have a short-term view. The next category are the ones who are looking at investing in a particular company, investing in a business, and they want to hold the stocks for the long term. And they don't necessarily care too much about the listing gains because they're not here for the short term, they're here for the long term. Okay, so there are these two categories of investors, and of course, you have to understand in which category you fall in, right? So, like I said, it is not necessary that every IPO is going to be giving you positive or great returns. So, just remember, for every L&T Infotech and a CDSL which have done exceptionally well and have been the wealth creators, you will have a Tara Jewels or a Future Supply that have never even seen their issue price since their IPO, right? So you have to, what you really have to look at is that whether you're a short-term investor or whether you're a long-term investor, you're putting in your hard-earned money, right? So it's important for you to take an informed decision about the company that you're investing in, which is very important, right? So now let's understand some very simple things about an IPO, right? So what exactly is an IPO? IPO is an initial public offer, right? So this is basically the first time that the company is offering shares to the public. Okay, so when a company is offering shares for the first time to the public, it's called an initial public offer. And obviously, they're doing it for multiple reasons, right? They want to raise capital, they want to use that money for expansion purposes. There could be multiple reasons, and we're going to talk about all of that. But yes, but the basic thing is that when the first time shares are offered to the public, that becomes an IPO. Right now, so let's understand the most basic difference. Before we understand about IPO, let's understand the difference between what is a secondary market and what is a primary market, right? So let's understand what are these two different markets, right? So every time shares are issued to the common public or to a limited set of investors, that's referred to as primary market. Okay, so every time new set of shares are issued to the common public or a limited set of shares, that's a primary issue. And in this case, there are two parties that are involved. Okay, so there's the company and there are the investors. That's it. There's nobody else. It's just the company and the investors. The company that's offering the shares, the investors that are buying the shares of the company. The issuance of shares to the public for the first time is called IPO. And then if there's a subsequent issue coming out, that's called an FPO, which is a follow-on public offering. Okay, that's called a follow-on public offering. Now, secondary market is basically the platform that enables exchange of shares or exchange of ownership. Okay, so when you have the existing shareholders and they probably want to sell their shares. Now, how do they sell their shares? They sell their shares through the secondary market, right? So stock exchanges like your Bombay Stock Exchange, your National Stock Exchange, all these are called your secondary markets. Okay, this is where you can trade your shares. You can buy and sell shares through the secondary markets. Yeah. Now, please remember that for an IPO, it is mandatory that every IPO has to be listed on the stock exchange. It is compulsory. Okay, because that would give an opportunity to investors to sell their shares or buy their shares at any point in time. So it is very mandatory that all the IPOs are listed on the stock exchange. Yep. Okay. So now let's understand the process of an IPO. So what's the process that a company follows to come up with an IPO, right? So first thing, or the very first thing that they do is they appoint investment bankers. Okay. Now, what's the role of these investment bankers and why do companies need these investment banks really when they are coming out with an IPO, right? So the investment bankers play multiple roles. Yes. And I think they play a very important role in an IPO. So the very first role, right, or the very first thing that an investment banks do is that they decide the valuation or the best possible valuation for the IPO, right? For example, when we say valuation, every company has a face value, and but they're not necessarily going to sell you shares on the face value. They're asking for a premium, right? They want a premium when they're selling shares in an IPO, right? So how much premium can they ask is valuation, right? How much premium can a company ask on their face value is nothing but valuation. Okay. Now, come to look at it, valuation is both art and science, right? So coming out with a valuation, the scientific method to come up with a valuation is science, but to justify that valuation is art. Okay. So how do you justify the valuation that you've come up with to the investors is an art. Okay. Now, then what the investment banks do is they would tie up with other financial institutions to sell that issue and to reach out to maximum investors. So obviously, the whole purpose of an IPO is to reach out to maximum people, right? So that is how the investment banks would then tie up with financial institutions to reach out to maximum people, for that particular issue, and they also underwrite the issue. So underwriting the issue basically means that if the company fails to raise the target amount, the underwriters would step in and buy the shares of that company which go unsubscribed. So the underwriter's role is that they would subscribe to the shares if it goes undersubscribed. Okay. But generally, obviously, to reduce the risk, the investment banks will basically form a syndicate. It won't be just one bank. It'll be multiple banks who would come together, or multiple merchant banks who would come together, so that just one investment bank doesn't have to take the whole risk if the issue goes undersubscribed. So today what we're going to do is we're going to understand everything about an IPO using one particular company, one particular IPO, right? And I'm going to use Nykaa as an example because Nykaa was, it's a pretty recent IPO. A lot of us loved the company. We wanted to invest in that. A lot of it went oversubscribed. So let's understand the whole process of IPO, everything about an IPO using Nykaa as the example. Okay. So Nykaa, or it's also called FSN e-commerce, right? And Ms. Falguni Nayak is the promoter of the company. So if we look at the investment banks of FSN, which is, or of Nykaa, the global coordinators and the book running lead managers were Kotak Mahindra Capital Company and Morgan Stanley. And the other lead managers of the issue were BofA Securities, Citi, ICICI Securities, and JM Financial. So these were basically the investment banks or the lead managers for this particular IPO. Okay. Okay. Moving on, now let's understand preparing the DRHP. So, what is DRHP? So, DRHP stands for Draft Red Herring Prospectus. Okay, so what is a draft red herring prospectus? Now, whenever you want to invest in a particular company or you want to invest in a business, right? What happens is that you can look at the annual report of the company and you can very well understand about the business and you could invest in that business. But for an IPO, that is not possible. So then what you do is you look at the RHP, which is the red herring prospectus. Okay, red herring prospectus is basically a document that is submitted to SEBI for approval, right? So every time an IPO has to be launched, the company obviously has to get the approval from SEBI, right? So so DRHP, I truly think, is something that we are trying to jargonize, but trust me, it's a very simple thing that you need to understand. So it's a draft document that is submitted to SEBI for approval. Okay, and this document has all the necessary information which SEBI seeks for an IPO. So whatever information that SEBI wants related to the IPO, related to the investors, everything is there in the DRHP. So, for example, for Nykaa, the DRHP was filed with SEBI in the first week of August. Okay. Next, what happens is SEBI verification, which is then SEBI will do its own due diligence. I mean, SEBI is a very pro-investor, regulator. I mean, they're very concerned about the investor interest, right? So they do a lot of checks and balances they have in place to make sure that the investors' interests are taken care of. So SEBI verification is an important step where SEBI does its own due diligence, puts feedbacks, put comments, and gives back the DRHP to the issuing company. And then you have the IPO pricing, which all of us should understand. Now, IPO price issue is a very, issue price is a very important thing. A lot of us look at the issue price. So let's understand how exactly what is the issue price, how it is fixed, and all of that. So generally, there are two types of issue price. So you have the fixed price issue, or you have the book built issue in India. Okay. And in India, mostly we look at the book built issue. Most of the IPOs that come out in India are book built issues. Okay. Now, what you have to understand is any company that is coming out with an IPO with an issue size of 10 crores and above, it is mandatory to go for a book built issue. And for others, it is voluntary. So if it is less than 10 crores, it is voluntary. But if it is more than 10 crores, they have to use the book built method. Okay. So what happens in a book building issue? So in a book building issue, basically the company sets a price band. So there is basically a floor price and there is a ceiling price. And based on the price band, the investors have to bid. So the bidding happens, and the investors can bid anywhere in the range from the floor price to the ceiling price. Okay, and then based on that, the shares are allotted. Now, in the modern world, it is only logical that to increase your probability of allotment, ideally you should bid at the highest price, which is at the ceiling price. If you bid at the highest price, your chances of allotment definitely goes up. Okay, so now if you look at the issue price of Nykaa, right? The issue price band for Nykaa was 1085 to 1125, which means 1085 to 1125. So which means the ceiling price was 1125. Okay. So now before we talk about any any company going public, right? Let's understand what is a fresh issue and what is an offer for sale. Okay. So what is a fresh issue? A fresh issue is when a company is offering fresh set of shares to the investors, which means the money that is collected in a fresh issue goes directly to the company, which the company can use for its own different purposes, right? Then we have offer for sale. I'm sure all of you in an IPO would have seen these two things, right? Offer for sale and a fresh issue. So what is an offer for sale? Offer for sale is when you have the existing investors, including the promoters, who are selling a part of their shares or all of their shares to the public to basically, get back their money, right? So basically, they want to liquidate their shares, and that is when offer for sale is done. So in this particular case, the money that is raised goes to the existing investor. So in an offer for sale, the money that is raised goes to the existing investors. So this is a way of liquidating the stake of the current investors, right? Now, if you look at the Nykaa IPO, for example, the issue size was about approximately 5352 crores, in which 630 crores was fresh issue and 4722 crores was offer for sale. Okay. Now, even if you look at other private companies on the likes of, say, Zomato, Paytm, generally it is a combination of fresh issue and offer for sale. But if you look at PSU entities, like you have IRCTC, LIC, all these IPOs which have come or are going to come, mostly they are offer for sale because the government is looking at liquidating its stake and getting money. So whenever the government needs money, right, for running, for basically purposes of running the country, then they can liquidate their stake in the PSU companies, right? So in the PSU companies, you will always see offer for sale. You will not see a fresh issue. Okay, great. So moving on, now let's understand a few other things about the IPO, right? So first, what I want all of you to understand is that why do companies go public? Like, what's the reason for companies to go public, right? Why do they want to have an IPO? They can just remain a private limited company and do well for themselves. But then why do they want to go public? So there are multiple reasons for it. The very first reason is they want to raise capital, right? So they want to raise capital because the company, needs money for expansion purposes, or it could just be that they have multiple reasons that they want to raise funds, right? So raise capital is one of the biggest reasons that they want to raise funds for expansion purposes. Next is to pay off existing shareholders. So like we've just discussed, right, an offer for sale, for example, that is nothing but paying off existing shareholders. So you have existing shareholders who are who want to liquidate their stake, and that is why an IPO comes out. Next, you have greater visibility. Now, this is super important because there are a lot of companies who get a lot of media attention because of an IPO, right? Even if the IPO is not super successful, at least they build a brand for themselves. So they become famous, and then they get a lot of visibility because you have media attention around them and so on, right? Now, the moment the company gets listed, also, they are answerable to SEBI and the stock exchanges, right? Because if they're listed, they're answerable to SEBI and the stock exchanges. So then this helps in improving their credibility as well, right? So the credibility improves because now they are listed, so they are answerable to a lot of entities. So a very good example would be companies like Happiest Minds or say CAMS. They got very good traction after the IPO, okay? And last reason is increased liquidity, right? So for example, you have the employees, you have the promoters, you have the venture capitalists who put in their hard-earned money, who put in their time, who put in the effort to really get the company to that particular level, right? That the company's been able to go for an IPO. Now, by going public, all these entities, right, they're able to encash their effort, right? So the employees, the venture capitalists, the promoters, all of them, they're able to encash all the effort that they've put in once the IPO comes out. So whether it's a Nykaa or a Paytm IPO, most of them had offer for sale component in the entire issue, right? And that offer for sale was basically for, there was a part of it which was for the employees, promoters, and so on, right? Okay, so moving on, now let's understand some of the key terms related to an IPO, right? So you've heard of a lot of these terms. Let's understand what all of these terms are and what happens. So first is basically IPO opening and closing date, right? So basically all the IPOs are open for a minimum of 3 days and a maximum of 10 days. Now, just because a company is coming out with an IPO, they cannot be open indefinitely, right? So there has to be a time frame that's given to them. So that's a time frame between which the investors can subscribe to the IPO. Okay, so now you have the open date and then you have the closing date, right? And that's a timeline where the applications are collected and, so basically people are subscribing to the IPO in that time frame. Then there's something called as the listing date. So listing date is basically the date when the IPO is listed on the stock exchange. So on the day when the IPO is listed on the stock exchange, that is called listing date, okay? So like I said, all the shares that have to be allotted before the IPO, so which means all the shares have to be allotted before the IPO gets listed on the stock exchange. So before the listing happens, the shares have to be allotted to the investors, and then once the listing happens, then the investors could trade. So they could sell their shares and all of that. Okay. So if you just look at the Nykaa IPO, the opening date was 28th of October 2021, and the closing date was 1st November 2021, and the listing date was 10th November 2021, which was they had almost about 9 days before listing, and in those 9 days they had to allot shares to all the investors. Okay. Next, we have the price band of an IPO, right? So what's a price band? So in a book building issue, for example, like I said, there's a bid range, right, between which the investors have to bid. Now that's called the price band. So there's a ceiling price, there's a floor price, and ceiling price is the maximum bid price, and the floor price is the minimum bid price. Okay. So like I said, for Nykaa, it was 1085 to 1125. So which means the investors could bid anywhere between 1085 to 1125. Okay. Next, you have something called as the cutoff price. Now, what exactly is a cutoff price? So basically, this is the price at which the shares are issued to the investors. So the price at which the shares are issued is the cutoff price. So in a book building issue, for example, the cutoff price is basically is the stated price range or above the floor price. The cutoff price is decided based on the price that most people are willing to pay. So if most people are willing to pay a particular price, that is decided as the cutoff price. So for example, the issue price was 1085 to 1125 for Nykaa, and the cutoff price was 1125, which was the ceiling price. Okay. So now let's understand this. Now suppose if you're looking at a particular IPO, let's just take Nykaa only for example, and you have 1085 to 1125. And say if suppose you have put a bid for 10 shares at 1082. Okay, you said okay, 1082 is the price that I'm bidding it, and the shares are allotted at 1081. Then you would if the cutoff price is 1081, then you would get the allotment. But if the cutoff price is 1084, then everyone who's put the bid below that cutoff price will not get the allotment. Okay. So anyone who has got or put a bid for higher than the cutoff price is the person who's going to get the allotment. Okay. Next, we have the listing price. Now, listing price is super interesting, right? Because that is what a lot of investors look for. So listing price is the price of each share when the IPO opens for the first day on the stock exchange, or basically its opening price on the listing day. So when you have the listing day, what's the opening price? That is basically the listing price. So a lot of investors, like I said, they subscribe to the IPO and then they hopefully wait for the listing price to be much higher or a premium to what they have paid, and then they encash their profit and sell their shares, right? Now, obviously, the demand and supply is what would determine the listing price, okay? And the listing price is decided by the investment bank that is basically helping the company with the IPO. So, like I said, the shares could be at the listing price could be the cutoff price, premium, par, or at discount. It could be anything. Okay, it depends on the demand and supply factors that determine what is the listing price. So, if we look at the Nykaa IPO, the cutoff price was 1125, and the listing price was 2018, which means 2018. So, which means investors got the allotment of shares at 1,125 per share, and they when the shares got listed 10 days later, the price of each share was 2018, which is almost a premium of 79%. Okay, that is how listing price is done. Next, we have something called as the lot size. So basically, lot size is basically the minimum number of shares that an investor has to apply for in an IPO. So if you want to bid for more shares, you will bid in multiples of the lot size. Okay, only in multiples of the lot size you can bid. Okay, so for example, if you have the lot size of an IPO, which is say 200, and then you have to bid for a minimum of 200 shares, and if you want more shares, then it will be multiples of 200. So it will be 400, 600, and so on. Okay, so you have to bid in multiples of the lot size. So in Nykaa IPO, for example, the lot size was 12 shares. So which means you had to buy a minimum of 12 shares. And if you wanted more shares, then it had to be multiples of those 12 shares. Next, we have the issue size, right? So what exactly is the issue size? So issue size is the total amount that is going to be collected in an IPO. That is the issue size, okay? So if you look at the issue size for Nykaa, that was 5,351.92 crores, which means Nykaa going to raise 5,352 crores through this particular IPO. And like I said, the fresh issue was 630 crores and offer for sale was about 4721.92 crores. Okay. Now, we have something interesting called the gray market price. And a lot of people look at the gray market price. So, what exactly is a gray market price? Okay. So when we look at the gray market price, it is basically it's a short-term thing. It's basically it tells you the short-term sentiment which is related to that particular IPO. It is simply taken as the listing gain that one can expect. So what is a listing gain that you can expect is your gray market premium, as we call it, right? So GMP is your gray market premium or gray market price. So this is a completely unofficial thing, okay? But people still look at it as an immediate market indicator with regard to the IPO, okay? So for example, the GMP for Nykaa was, it started with 550 to 600 rupees in the early days. And it went up to 765 rupees, the premium, so gray market premium, after the allotment of the shares. And this was touted to be a sign of strong listing gains. So it was believed that the listings gains are going to be strong because of the kind of gray market premium that was floating around. So essentially, the premium is over and above the issue price. Okay, that is what you have to understand. A lot of people look at GMP if they want to subscribe to an IPO, but remember, it is completely unofficial, but still is a good indicator. Okay. Now we have to understand what are different types of investors or buyers that we have in an IPO. So imagine if there was no distinction, right? Imagine if there was no distinction between different categories of investors, then I do believe that probably the whole allotment of an IPO would have gone to only qualified institutional buyers or whatever, right? So which is why it is very important that, so SEBI has basically defined different categories of investors and there's a specific allotment for each category of investors, okay? So like I said, there are 4 types of investors. There's retail investors, non-institutional investors, qualified institutional buyers, and anchor investors. So let's understand each of these categories, right? So what exactly is a retail investor? So retail investor is anyone who is investing up to 2 lakhs in an IPO. So if the application size is 2 lakhs or below, that particular individual is called a retail investor. But under this category, you have resident and non-resident individuals, and even HUFs come under the retail investors category. Okay. Now, anyone who is investing more than 2 lakhs, okay, will fall under non-institutional investor. Okay, so anyone who's investing more than 2 lakhs is called as a non-institutional investor. Now, unlike the retail investor category, right, this particular category, which is non-institutional investors, is meant, what is it meant for? It's of course meant for individuals and HUFs, but it is also meant for trusts, it is meant for companies, societies. All of them can invest along with individuals and HUFs, okay? And NIIs need not be registered with SEBI. They need not be registered with SEBI. Just the application size is going to make all the difference. Yes? Then you have another big category, which is your qualified institutional buyers, right? So your qualified institutional buyers is a big category of investors. So these are typically the QIIs, right? QIBs. They are mostly the financial institutions like mutual funds, insurance companies, or it could be commercial banks, public financial institutions, foreign portfolio investors, FPIs, and so on. And all these entities have to be registered with SEBI. So when we look at the qualified institutional buyers, all of them have to be registered with SEBI. Now, what you also have to understand is we have a voluntary book build issue and we have a compulsory book build issue, right? So the percentage of these investors keeps changing. So in a voluntary book build issue, which means the issue size is less than 10 crores, retail investor category is minimum 35%, which means minimum 35% allotment should go to retail investors and minimum 15% should go to non-institutional investors. And for qualified institutional buyers, it is maximum 50%. But if you look at the compulsory book build issue, right, which means that the issue size is more than 10 crores, then retail investors is a maximum of 10%. Non-institutional investors is a maximum of 15%, and your qualified institutional buyers is minimum 75%, which means higher preference is given to QIBs when the issue size is bigger. Okay. So if you look at the Nykaa IPO, for example, the QIIs, qualified institutional buyers, they subscribe 91 times in this particular IPO, right? Now we have something called as anchor investors. Very interesting category. What are anchor investors? So anchor investors, basically, they have to invest in an IPO before the subscription opens to public. So before the IPO opens up to public, the anchor investors have to invest in an IPO. The maximum allocation to anchor investors is limited to 60% of the IPO size. Okay. Now, why do we need anchor investors? So basically, you have a large participation from anchor investors that provides a signal to prospective investors. So if there are a lot of anchor investors, it gives a signal that probably this IPO is good, right? Because there are so many anchor investors who are investing in this business. And anchor investors, they basically help to jazz up the popularity of the issue, right? They help to increase the popularity of the issue. And the anchor investors, they have to buy the shares at a fixed price. Okay. There's no price band given to them. They have to buy the shares at a fixed price. And this makes the investors more confident, right? So if you look at the Nykaa IPO again, anchor investors participate to the extent of 2,396 crores. Okay. And you had institutions like BlackRock Global Funds, Fidelity Funds, Nomura, Government of Singapore, Monetary Authority of Singapore, Canada Pension Plan Investment Board, T. Rao Price, Tiger Global Investments, so many anchor investors. And these anchor investors, they were offered the shares at 1125 per share, right? Which is the ceiling price for us. They were offered the share only at that fixed price. They were not given a band. Okay. And then you also had a lot of domestic mutual funds that participated as anchor investors in the IPO, right? So you had Aditya Birla Sun Life Mutual Fund, Axis, HDFC, SBI, Sundaram, Tata, UTI, all these mutual funds invested in the Nykaa IPO. Okay. Now let's understand a very interesting thing, which is the RHP, right? So what exactly is an RHP? RHP is the red herring prospectus. Sounds complicated. Just think of it as an offer document. Think of it as a document that you can refer to and understand about the company if you really want to invest in that particular IPO, right? So for you to understand everything about an IPO, about the company, you can look at the RHP of that particular company, right? So today I'm going to explain RHP through Nykaa RHP, right? So let's understand, how the Nykaa RHP worked, and then you'll be able to look at the other RHPs yourself, right? So like I said, just blindly investing in an IPO is not going to help. You have to look at how the company is doing and so on, right? Now, SEBI has mandated all the companies that want to come out with an IPO to provide certain information about their business, their financials, the risks associated, and all of that. And all that information is provided in our red herring prospectus, right? And obviously, this is available in the public domain for all of us to see. So all of us have access to the RHP of a company which is coming out with its IPO. Right now, what you have to also understand is the very basis of new gen companies getting such valuations, right? So you have a lot of new gen companies, Zomato, and you have Nike, and you have so many other new generation companies that are getting crazy valuations, right? It is because I do think because of the new India, right? The rising middle class, you have people earning well, they're willing to spend more money on their lifestyle, on buying things, on luxury. And obviously, it's all available at the click of a button, right? Everything is available at the click of a button. So the new gen companies are creating a lot of buzz, right? There's no denying that. They are creating a lot of buzz. And if you look at Nykaa, for example, because today we are analyzing Nykaa, Nykaa is in the fashion industry. If you look at Groww, it's in the financial services industry. If you look at Ola, it's in the transportation industry. But all of them are new gen tech companies, right? So what are they doing? These new gen tech companies are basically nothing but they are older businesses. They're just creating a layer of technology on the existing business, right? And they're making those industries more accessible to the end consumer, right? So the businesses are the same conventional businesses. They are just creating a layer of technology to make it more accessible to us, right? So whenever you're looking at analyzing a company, what you have to look at is to start with the industry, right? So I'm just going to now share the RHP with all of you, right? So let me just quickly do that. So I've opened the Nykaa RHP for you guys. Yes, so this is the Nykaa RHP, the red herring prospectus. So what do you start with? You start with the industry analysis. And what I'm going to do is I'm just going to make it a little more bigger, right? So I'm, yeah, so don't worry, it will be visible to all of you. Absolutely don't worry about it. And let me quickly show you how the RHP exactly works, right? So if first we'll start with the industry analysis. So I'm going to show you. So you go to the page where the industry analysis is there. So you look at the industry overview, right? So if you look at this particular company, and I've gone to the industry overview page. So first is the higher younger population, right? So if I just show you these charts, just 1 minute. Yes, okay. So Gen Z and millennials, right, who are considered as the biggest spenders, this share in the population is expected to increase, and they are likely to spend more on personal care and beauty. Right? And that's the exact right target customer for Nykaa. Right. So if you look at India, for example, right, look at this. It is expected to grow by 51% versus other countries like China and US and so on. So India, in terms of the, it just if you just look at the population in general, it is expected to grow drastically in this particular space. Then you have India's digitizing trend and use of mobile phone. India not just has higher smartphone using population, but we also spend higher time per day, which is almost 4.6 hours per day compared to a lot of other countries like China, US, UK, etc. Right? And then you have, so let me just go to that chart, right? Yeah. And then you have online shoppers, which from current 11 to 13% of the population is expected to grow to 24 to 28% by 2025. And along with the growth in the technology space, it is also important to understand the potential growth in the retail industry space, right? So whenever you're looking at these new gen companies, of course, you look at how technology is expected to grow, but look at also how the base company is expected to grow, right? The base industry of that particular company. So as you can see, the access to internet, online service users, look at 2020 and 2025, look at the kind of growth that is expected, right? So when you're looking at the RHP, for example, you look at all these aspects which are very, very important. Then after you've done the industry analysis, of course, you look at the company, right? So now let me just quickly go to that particular page. When you're looking at the company, we have to look at the business, right? So what exactly is the company into? What are their future plans? What is it that they are offering? What is it that they want to do? And so on. Yes. So what are their operations like? So you could look at the product range. You could look at operations, manufacturing capability, if they're into manufacturing, for example, and understand what differentiates a company from its competition. So even the Nykaa is a company that offers beauty products via e-commerce platforms. You have Amazon, Flipkarts, and Mintras of the world who can be considered as direct competition, since they're all retail giants, right? They sell everything that Nykaa sells plus many other products. So their direct competition to Nykaa would be an Amazon, Flipkart, and so on, right? So you have to understand these aspects. Next, what you have to look at is the shareholding pattern, right? And I think this is super important because what happens is that when it comes to a lot of companies, right? So if you just look at this, yeah. So this is the shareholding pattern of the promoters, yeah. So in Nykaa, for example, unlike other tech startups, we have seen where founders or promoters have single-digit holding or less than 20%. In Nykaa, the founders hold close to 54%. As you can see, 54.25% is what the Nair family alone holds, right? And that is what that differentiates. Next is the use of IPO money is what you should look at. So what are they going to use that money for, right? And I'm going to show you that. So what they, so for example, how the company would be utilizing those funds, right? So like I said, the IPO issue for Nykaa was a combination of offer for sale and a fresh issue. So what is the fresh issue going to be, that money that they're going to raise? What is it that they're going to use for? So they're going to use for expansion activities. Like Nykaa plans to invest around 42 crores in some of its subsidiaries like FSN Brands or Nykaa Fashion for funding the setup of new retail stores. Just 1 minute. I think I've put it in a slide. So let me just share that. And I think that would be a little more, clear to you. Just give me 1 moment. Yes. So as you guys can see this, yes. Okay. Right. So what you have to understand is that Nykaa plans to invest about 42 crores, of course, in subsidiaries, then repayment of loans. So they have a lot of loans that they wanted to repay, right? So Nykaa plans to use about 156 crores towards repayment or prepayment of outstanding borrowings, availed by the company or one of their subsidiaries like Nykaa e-retail. And then of course for brand building activity, they're going to use that money for building their brand. So they're going to spend about 234 crores to acquire and retain customers by enhancing the visibility and awareness of its various brands, and then of course for general corporate purposes. Now, what you also have to understand is the peer group comparison, right? This is truly very important, because when you're looking at peer group comparison, this is generally not covered in detail in the RHP. But you will ideally have to look for answers. So, for example, in India, there's no company that specializes in fashion e-tailing. Okay, there are smaller players like you have Plum, you have Purple, etc., who are much smaller compared to Nykaa. Hence, peer group comparison is tough. But when compared to other existing tech players like InfoEdge, IndiaMart International, Nykaa IPO did command an expensive valuation, right? It was also because of the robust revenue numbers and growth prospects. So, due to this, many brokerages, they had this buy signal because of the kind of value, the kind of financials that the company showed. So, the company showed very robust financials. That was one of those very few IPOs or companies that showed profitability, right, which doesn't happen generally. So yes, so what I'm trying to say is that when it comes to any IPO, right, you have to do your analysis in terms of understanding different aspects about the company, right? You cannot just invest in an IPO because there's buzz around it, or because you think that it is, you assume that it is going to do well. You have to look at logical reasons and then invest in a particular IPO. Yes. So now I'm sure a lot of you want to know, how do I increase my chances of getting an IPO, right? So if I want to get that allotment, how do I increase my chances? So that is what I'm going to tell you now. Okay. So many people, they subscribe to an IPO, they really want the allotment, but not everyone gets the allotment. That's one. And also, then we get disappointed and we're like, we really want the allotment. So how do I increase my chances? So first thing is, many people use the same PAN number on different platforms to submit the IPO, multiple IPO applications, right? So you should avoid this. So ideally use multiple demat accounts which are linked to different PAN numbers, right? Now that obviously increases your chances of getting the allotment in an IPO. I'm sure you understand that. So you would actually see a lot of investors who are using demats accounts of their family members, of their friends, to really subscribe to a particular IPO. So use different PAN numbers to subscribe to a particular IPO. Okay, that's one. Then obviously, bid at the maximum price, right? So you have the ceiling price. Bid at the ceiling price, then your chances of getting the allotment definitely increases, isn't it? So if suppose the range is 100 to 105, then bid at 105, so that you bid the highest, right? So your chances are definitely higher. Yeah. In the Groww app, for example, the maximum price is taken automatically. The bid price is taken as a maximum price automatically, but of course you have the option to change it if you want, right? Next, to avoid this last minute rush, right? So a lot of people, they want to see the response of an IPO in the first 2 3 days, and then they want to apply on the third day, right? Even if you want to do that, please do it before 3 p.m., because you might just face some technical issues or some processing issues towards the later part, because of which lot of traffic and so on, because of which you might not be able to subscribe. So avoid this last minute rush. Don't, if you are convinced about the company, don't wait, just subscribe, right? And also, please be very careful when you're filling in your details, right? Because there are so many IPO applications that get rejected because of technical reasons, right? Simple things like the name being different on the PAN card versus your bank account. The name is different, right? Now, that's a technical issue because of which you will not get the allotment. So, because these small things, if you're not getting the allotment, then you would feel then it's not right, right? So, make sure that be careful. It's the details that you would actually be able to make a lot of difference, right? So which is why make sure that you fill in the right information, which is very important. Then what is very interesting is that you could buy the shares of the parent company if it is listed. So if the parent company is listed, then your chances of getting an allotment in the IPO increases, right? Because then you are actually applying under the shareholder category and not under the retail category. So your chances are much higher. So, and obviously there were very few IPOs like this. So, for example, when cards came out with their IPO, then SBI's shareholders had this advantage, right? So, if you think that there's a parent company which is already existing, then you should look at investing in the parent company. So you fall under the shareholder category, not under the retail category. So others, like I said, SBI Cards are a classic example, right? So SBI Cards IPO, if you had already bought shares of SBI, then your chance of getting allotment in SBI Cards was much higher. Okay, and then many people believe that they'll bid for more lots and they'll get allotment. That is not going to make any difference, right? That is not going to make increase your chances of getting the allotment, because all the bids are treated equally, be it one lot or multiple lots, doesn't matter. Clear? So yes, so that is how you can increase your chances of getting an IPO. Okay, so great. So I think with that, we've had a pretty detailed discussion around how IPOs work and what you can do about it. So open to questions now, and if you guys have any questions, I'll be more than happy to answer it. So let me just go through the questions. Okay, someone's asking, we apply for IPO or just need to settle it down in market and then take positions afterwards? What's the best approach? Okay, so there's no standard template to this. I mean, if you find a good company with good fundamentals, then there's no harm in applying for an IPO. Like I said, if you're lucky, you will get the allotment, right? If you think valuation is expensive and market is also perceiving the same, then it makes sense to wait for the listing. So if you think that it is expensive, the valuation is on the higher side, let's just wait for the listing, because you can always buy the shares from the secondary market once they are listed. Okay. So someone is asking about index funds. So let me just quickly tell you how to select an index fund, right? So selecting an index fund is relatively easy. It's not such a big deal. Look for a fund with lower expense ratio and low cash holding, right? So if you're looking for a fund with lower expense ratio and lower cash holdings, that should help. The performance of such funds would be close to market returns. And you could also consider funds with relatively higher AUMs, right? Because in terms of performance, it's going to be the same. They're going to replicate the market, right? So of course, you could look for lower expense ratio, low cash holding, or you could consider funds with higher AUM. Okay, someone's asking, can you please explain CAGR, right? So I got that. So compounded annualized growth rate, that's the full form. So this is basically used to compute the returns when the holding period of investments is more than 1 year. So when the holding period is more than 1 year, then CAGR is used in terms of computation of returns. It is nothing but the average returns over a period of time. Okay. So for example, markets have done well, then they've not done so well, then they've done well, they've not done so well. So if you look at the average returns, that would be calculated as CAGR. Okay. Okay, market regulator SEBI has reduced, want to know new SEBI rules. Okay, so they want to know the new SEBI rules for promoters. Okay. So if you look at the new SEBI rules, the minimum lock-in period for promoters investment post an initial IPO, is about, it has changed from 18 months to 3 years under certain conditions. Even the concept of company promoters, right? SEBI has changed towards the idea of person in control. Yeah, so basically person in control. So the proposal has been introduced because conventional Indian ownership structure was more than one person or a person's control. They basically control an entity, right? The startup ventures and most celebrated unicorns of the industry have substantial investments from institutional investors and PE players, right? Who exercise control over the decision-making process through, the board representation and other means. Hence, hence the definition had to change. Yeah, so SEBI has changed the definition, which you should look up on the SEBI website as well. Yeah. Okay. Which IPOs to avoid? Okay. So how do you? So this is a very difficult thing, right? Because when we look at IPOs, of course, look at the RHP is what I would say. And if you truly think that this particular company is worth investing in, then you should look at investing. Now, but again, if you're a short-term investor who's just looking at listing gains, right? Then if you think the company is undervalued, then you can invest, right? Because then you would be able to get decent listing gains. But if you think that the company is already overvalued, right? Then it may not make sense to invest during an IPO, but it would make sense to invest once the listing happens at a later time. Right? Valuation is a topic in itself, right? And like I said, there is no simple logic in terms of why companies are valued at a particular price, because like I said, the new gen companies are demanding higher valuation of late, and that's how it is. Yeah. So yes. Is it necessary to read all the 590 pages of an RHP? No, it is not necessary. I don't think any of us can read all the 590 pages, but you should understand the basic things, right? So, like the things that I spoke about. So, understand about the industry, understand about the company, what are they into, understand about their competition. Then there's a whole section on risk. So, understand about the risk. Then we have understand about the financials. So, they post all the financials. So, you should understand about the financials. So, look at the income statement, basically income and expense statement, look at the balance sheet, look at the cash flow statement. So look at these few basic financial statements, and to a large extent you'll be able to figure out if the company is worth investing in. You don't have to read all the pages. You should look at these basic aspects. That should do the trick. Okay. Great. So I think we are good to go. Thank you so much for joining us. If you have any questions, just feel free to mention it on the comments, and the Groww team will get back to you with the answers. And thank you so much again for joining me. I do hope all of you were able to get good insights in terms of how IPOs work. And I'm going to be doing the same session at 12:30 now, which is going to be in Hindi. So if you want to listen to this again in Hindi, do feel free to join me. So thank you so much, guys, and I wish you all the best. Take care. Bye-bye.